Hey there, welcome back to our channel. In today's video, we will be talking about Chapter 1 of The Intelligent Investor by Benjamin Graham.
This chapter is titled as Investment versus Speculation, Results to be Expected by the Intelligent Investor. In this chapter, Graham makes the case for the importance of investing versus speculating and outlines the principles that define intelligent investing.
Graham begins the chapter by distinguishing between investing and speculation. He defines investing as an operation which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. He goes on to argue that while speculation may be exciting, it is not a reliable way to build wealth over the long term.
The key principle that separates investing from speculation, according to Graham, is the focus on safety of principal. Intelligent investors prioritize the preservation of their capital over the pursuit of high returns. Graham warns against the temptation to chase after the latest hot stock or market trend, as this is often a recipe for disaster.
To illustrate his point, Graham uses the example of the stock market crash of 1929. He notes that many investors who had been speculating on the market ended up losing everything when the bubble burst. By contrast, those who had been investing intelligently by focusing on undervalued companies with strong fundamentals were able to weather the storm and eventually recover their losses.
Graham also emphasizes the importance of adequate return. While safety of principal should always be the top priority, investors must also ensure that they are earning a reasonable return on their investments. Graham advises investors to aim for a return that is higher than the rate of inflation, but not so high that it requires taking on excessive risk.
One of the key themes of the chapter is the idea that intelligent investing requires discipline and patience. Graham cautions against making impulsive decisions based on emotion or the latest market news. Instead, he advises investors to focus on the fundamentals of the companies they are considering investing in and to have a long-term perspective.
Another important concept introduced in this chapter is the idea of Mr. Market. Graham uses this metaphor to describe the volatility of the stock market and the irrationality of some market participants. He argues that investors should view the market not as a reliable indicator of value, but rather as a source of potential opportunities to buy or sell based on the underlying fundamentals of individual companies.
Throughout the chapter, Graham stresses the importance of education and analysis in intelligent investing. He argues that investors must be willing to do their homework and thoroughly evaluate the companies they are considering investing in. This involves looking at a variety of factors, including financial statements, industry trends, and a competitive landscape.
Finally, Graham notes that intelligent investing requires a willingness to go against the crowd. He argues that the most successful investors are those who are able to identify opportunities that the market has overlooked or undervalued. This requires a willingness to be contrarian and to think independently.
In conclusion, Chapter 1 of The Intelligent Investor lays out the foundational principles of intelligent investing. Graham emphasizes the importance of focusing on safety of principal, adequate return, discipline, and patience. He also introduces the concept of Mr. Market and stresses the importance of education, analysis, and independent thinking. By following these principles, Graham argues, investors can build a successful long-term investment strategy that will withstand the ups and downs of the market.
So that's it for today's video. If you enjoyed it, don't forget to give it a thumbs up and share it with your friends. Also, make sure to subscribe to our channel for more videos like this. Thanks for watching and we will see you in the next one.